Hi, this is Amin, a California-based registered investment advisor. This week's big story, another stellar earnings season is wrapping up. So far, about 85% of S&P 500 companies have reported their third quarter results, and earnings are up 11% from a year ago, continuing a four-quarter streak of strong double-digit growth. While this reflects widespread corporate health, the tech and healthcare sectors were major standouts. One of the most striking things this quarter was how many companies blew past Wall Street expectations. A whopping 83% of S&P 500 firms reported better than expected earnings, the highest rate since early 2021. Not only did they beat expectations, but they did so by a healthy margin, about 8% above analyst predictions, which is double the historical average. Much of this success is thanks to the largest technology companies, sometimes called the Magnificent Seven. These giants, including Apple, Amazon, Google, Microsoft, and Nvidia, posted yearly earnings growth of over 15% alongside strong sales. But it wasn't just them. The rest of the market also grew at a solid pace, with industrial, utility, and consumer companies showing notable strength. All of this was supported by companies keeping a tight lid on costs and improving their profit margins. These strong earnings signal that U.S. companies are successfully navigating challenging conditions, from high interest rates to global uncertainty. This resilience is good news for both the stock market and the wider economy, boosting investor confidence and potentially driving future market gains. In short, the third quarter of 2025 adds another impressive chapter to corporate America's recent performance. With technology leading the charge, strong profits, and widespread earnings beats, the corporate landscape looks robust. That's good news for both investors and the U.S. economy. Let's pivot next to a new idea bubbling up in economic circles, the higher velocity economy. For years, the American economy was powered by consumers buying goods and services. But this new theory suggests that the engine of growth is shifting from consumer-led spending to business capital investment. Simply put, companies are now spending far more on new equipment, technology, and facilities than consumers are on lattes and cars. And it's this corporate spending that's making the economy run faster. This shift is accelerating thanks to a combination of government policies and market forces. On the policy side, things like tax benefits, including 100% expensing of capital expenditures, and deregulation are freeing up corporate cash, encouraging companies to invest in productive assets. Companies are making these big moves because they believe the investments will quickly boost their productivity and profits. When they build new factories, buy advanced machinery, and fund massive tech projects, it creates a powerful ripple effect that gets the economy moving faster. For the U.S., this means an economy increasingly fueled by surge in business activity, especially in the industrial and technology sectors. You can see it in the booming construction of data centers and new energy projects. However, there's a catch. This growth might not feel shared equally by everyone. In this new model, the average American consumer is no longer the main driver of growth. While their spending is still important, if the economy is powered mostly by corporate profits and high-tech efficiency, the typical household might not see a proportional boost in wages or financial security. This could lead to a perception that the economy is working great for corporations and the wealthy, but not for the average people. For financial markets, this changes the game for investors. Instead of just focusing on companies that sell to consumers, investors are shifting towards sectors that enable this capital investment boom. This includes industrial companies, semiconductor makers, equipment providers, and even utility companies. The stock market may be increasingly dominated by asset-heavy firms that are building the future, potentially shifting leadership away from the asset-light technology and consumer services companies we've grown used to. Perhaps the biggest puzzle of this higher velocity economy is the potential for a strange disconnect, strong economic growth happening alongside sluggish job growth. This isn't a normal sign of a weakening economy. It's a productivity paradox. Companies are investing in technology that makes their existing workforce incredibly efficient or even replaces human labor entirely. This all points to an issue of technological unemployment driven by automation and AI. While new high-skilled jobs are created, the number of middle and low-skilled jobs that are automated away may be even greater. A company may double its output without hiring significantly more people. This leads to high economic figures, but slow wage growth for many workers, risking a rise in wealth inequality as the benefits of increased productivity flow mainly to shareholders and company leaders, but not to employees. The single biggest factor driving this new capital investment cycle is the massive build-out of AI infrastructure. The world's largest technology companies, known as hyperscalers, are in a full-blown AI arms race, pouring colossal sums into building the data centers, servers, and networks needed for powerful AI models. To give you an idea of the scale, top U.S. technology companies are expected to spend $400 billion in the next year in capital expenditures alone on AI-related capital. This unprecedented private investment is creating huge demand for everything from construction materials to advanced electronics. This massive AI build-out is also putting a significant strain on our core utility systems. AI data centers are incredibly power hungry, creating a demand shock for electricity. Our power grids will have to expand rapidly, meaning huge investments in new power generation, both traditional and renewable, as well as grid modernization. So, companies that were once considered safe, steady investments, the utilities, are now at the center of the high-tech AI boom. One potential downside from the shift to a higher velocity economy is a capital overspend, which leads to a glut and to an economic bust. We saw this with the build-out of the railroads in the mid-1800s and, most recently, in the technology bust of the early 2000s. That's it for this week. New episodes come out every Friday. As always, your feedback is welcome. You can find my email in the show notes. Thanks for listening, and happy investing.